Basics of Investing. Chapter 11. Advanced Risk and Capital Preservation. Section 1. Risk per trade. Risk per trade is the amount you decide you can afford to lose if the trade is wrong and the stop loss gets hit. That makes it a pre-trade decision, not something you figure out after the market moves against you. Most investors and traders express it as a small percentage of account equity, often somewhere around 0.5% to 2%. In a $10,000 account, a 1% risk limit means the maximum planned loss is $100 on that trade. The real value of this rule is that it prevents any single idea from doing outsized damage. Even a good strategy will have losing trades, so survival depends on keeping each loss small enough that you can continue operating with discipline. Risk per trade and position size are related, but they are not interchangeable. Position size is simply how much you buy or sell, while risk per trade is how much money you stand to lose if the stop is hit. A large position can still have modest risk if the stop is very tight, and a small position can still be risky if the stop is far away. That is why disciplined sizing always starts with the distance from entry to stop, not just with how many shares or contracts feel comfortable. If you only look at size, you can fool yourself into thinking a trade is conservative when it is not. The market only cares about your actual dollar exposure to loss. Using a percentage of equity keeps risk in proportion as your account changes over time. When the account grows, the dollar amount you are allowed to risk grows with it, so your sizing scales naturally. When the account shrinks, the rule automatically cuts your allowed risk, which helps slow the damage during a drawdown. Compare that with a fixed dollar rule, such as always risking $500 no matter what. $500 may be 1% of a $50,000 account, but it becomes 2% if the account falls to $25,000. The percentage approach is adaptive, and that adaptability is one of the quiet ways disciplined risk control protects capital. The position size formula turns a risk rule into an actual number of shares, contracts, or units. You start with your risk budget, which is current equity multiplied by your chosen risk percentage. Then you calculate per unit risk by taking the difference between your entry price and your stop price. Once you have those two inputs, position size is just risk budget divided by per unit risk. If your account is $10,000 and you risk 1%, your budget is $100. If the trade risks $2 per share, the correct size is 50 shares. The final habit that matters is rounding down, because rounding up means you are choosing to exceed your own limit. A stock example makes the logic concrete. Suppose you have a $50,000 account and you plan to buy a stock at $100 with a stop at $95. That means the risk is $5 per share. If your rule is to risk 1% of equity, your maximum loss is $500, and $500 and 500 divided by 5 gives you 100 shares. If your rule were 2% instead, the same setup would allow $1,000 of risk, which supports 200 shares. The trade itself did not change at all. Only the risk budget changed, and that is what changed the position size. In practice, good sizing comes from following the same sequence every time. First, check current account equity rather than relying on an old number. Second, choose the risk percentage that fits your plan, such as 1%. Third, translate that into a maximum dollar loss. Fourth, define the trade properly by setting an entry, a stop, and the resulting risk per share or per contract. Then divide the dollar risk budget by the per unit risk and round down to a tradable size. If the answer is too small to be worthwhile or not tradable at all, skipping the setup is not a mistake. It is exactly what disciplined risk management is supposed to produce. Sometimes the correct size is 0, and that is an important result to accept. Imagine a $20,000 account with a 1% risk limit, so the maximum allowed loss is $200. If one crude oil contract would expose you to $1,500 of loss, it simply does not fit. If an E-mini contract still risks $750, that also does not fit. The formula is not failing in those cases. It is telling you the instrument is too large for the account and the rule. Many avoidable blowups begin when people override that answer because they want to participate anyway. When a standard instrument is too large, the sensible solution is often to change the instrument, not the risk rule. If your maximum allowed loss is $200 and a micro contract risks $75, the trade may become possible. 200 divided by 75 gives about 2. 66 contracts, and because risk discipline matters, you round down to 2. That leaves actual total risk of $150, which is safely within the limit. This is a powerful idea because it lets smaller accounts participate without pretending they can absorb large unit risk. The discipline stays the same, only the vehicle changes. Small losses matter because recovery math becomes much harder as drawdowns deepen. A 10% loss requires about an 1% gain just to get back to even. A 25% loss needs 3%, and a 50% loss requires a full 100% gain. That progression is why capital preservation is not just about avoiding pain, it is about preserving future opportunity. If losses remain modest, recovery is realistic and your edge still has time to work. If losses become severe, the account can spend years trying to climb back. The Kelly criterion is often presented as a way to find an optimal fraction of capital to risk for growth, assuming you know the odds and payoff structure of your edge. In theory, that can be useful, but full Kelly can create very large swings in real portfolios. Those swings are psychologically difficult and can be financially damaging if your estimates are even slightly wrong. That is why many practitioners use fractional Kelly or ignore the formula entirely in favor of small fixed risk limits. In real markets, survival usually matters more than maximizing theoretical growth. That is one reason many disciplined traders still stay near the 1 to 2% range per trade, even when models suggest they could risk more. Most position sizing mistakes come from breaking the process, not from misunderstanding arithmetic. One common error is confusing a big position with big risk or a small position with safety, without checking the stop distance. Another is using buying power or margin room instead of actual account equity, which can lead to oversized trades. Rounding up instead of down also quietly pushes risk beyond the intended limit. Some investors force trades that do not fit their rules because they like the setup, and others forget that stops are only estimates when gap risk is involved. Planned risk is never a guarantee, so the safer habit is to keep risk modest and follow the process consistently. Section 2. Portfolio risk. Portfolio risk is the uncertainty of returns for the whole collection of investments you hold together. The key idea is that total risk is not just the sum of each holding's standalone risk. What matters just as much is how those holdings move relative to one another. If several assets tend to fall at the same time, the portfolio can behave as though it is more concentrated than it looks. If they respond differently to economic conditions, one position can help offset another. That is why diversification is about the interaction between assets, not just about owning a larger number of them. A common way to measure portfolio risk is standard deviation, which captures how widely returns tend to fluctuate around their average. Higher standard deviation means a bumpier ride and larger typical swings. Variance is simply standard deviation squared, on its own. Variance is less intuitive, but it is very useful in portfolio math, because it fits neatly into formulas. In practice, people often calculate variance first, and then take the square root at the end to get back to standard deviation. So when you hear that a portfolio has higher volatility, standard deviation is usually the statistic being referenced. For a two-asset portfolio, the variance formula combines three pieces. The first two terms capture the standalone risk of each asset, adjusted for how much of the portfolio each one represents. The third term is the interaction term, and that is where correlation enters the picture. It reflects how much the two assets tend to move together. If correlation is high and positive, that interaction term pushes portfolio risk higher. If correlation is low or negative, the interaction term becomes smaller, and in some cases, it reduces total risk substantially. This is why portfolio risk is not a simple weighted average of individual volatilities. Correlation matters because it tells you whether assets tend to rise and fall together, move independently, or offset each other. A correlation of +1 means they move perfectly together, which offers very little diversification benefit. A correlation of 0 means there is no consistent linear relationship, so their movements are less tied. A correlation of -1 means they move perfectly opposite, which is the strongest form of diversification in theory. In real portfolios, most relationships fall somewhere between those extremes. The practical lesson is that lower correlation usually improves diversification, but during stress markets, those correlations can rise and reduce the benefit. Portfolio risk includes both systematic and unsystematic components. Systematic risk is market-wide risk, such as recessions, inflation shocks, or changes in interest rates, and it affects many assets at once. Unsystematic risk is specific to a company, sector, or individual security, such as a scandal, product failure, or regulatory problem. Diversification is very effective at reducing unsystematic risk because that kind of risk can be spread across many holdings. But diversification cannot fully remove systematic risk because broad market forces still reach most of the portfolio. That distinction helps explain why even diversified portfolios can suffer during major market downturns. To calculate portfolio risk in a practical way, start by setting the portfolio weights and making sure they add up to 100%. Then, estimate the standard deviation of each asset, usually from historical return data. After that, bring in the relationship term by using either correlation or covariance between the assets. With those inputs, you can compute portfolio variance using the formula. The last step is to take the square root of variance to get portfolio standard deviation, which is easier to interpret as volatility. The estimate is only as good as the inputs, so it should be treated as a guide rather than a fixed truth. A worked example shows why diversification can reduce risk below what a simple average suggests. Suppose asset A is 60% of the portfolio with volatility of 20%, and asset B is 40% with volatility of 30%. If the correlation between them is 0.30, the portfolio variance works out to 0.30. The portfolio variance works out to 0.03744, which gives a standard deviation of about 35%. A simple weighted average of the two volatilities would have been 24%. That gap, about 465 percentage points, is the diversification benefit created by imperfect correlation. In other words, the assets are still risky, but because they do not move in lockstep, the portfolio swings less than the average of their standalone risks. Better diversification comes from what you own, not just from how many line items appear in the account. You can own 10 different stocks and still be heavily exposed to the same underlying risk if they all depend on the same economic drivers. Position size matters too, because a small diversifying position may have very little effect on total portfolio behavior. A portfolio with fewer assets can actually be more resilient if those assets respond differently to growth, inflation, rates, or market stress. Another complication is that correlation can rise when markets are under pressure. So diversification is something you evaluate by behavior and exposure, not by counting holdings. Standard deviation is useful, but it treats upside surprises and downside surprises as equally important. For capital preservation, investors often care much more about losses than unexpectedly strong returns. That is why downside-focused measures can add value. Semivariance looks only at returns below a target or threshold, so it isolates harmful variability. Value at risk, or VR, estimates a loss level associated with a chosen confidence level, such as the loss you would expect not to exceed 95% of the time under the model. These tools can sharpen your focus on downside exposure, but they still depend on assumptions, data quality, and model choice. The practical takeaway is that preserving capital requires thinking about portfolios as systems, not as isolated positions. Individual asset volatility matters, but so do correlation, concentration, and downside sensitivity. A weighted average of standalone risk is not enough because it ignores how holdings interact, especially when markets become stressed. Thoughtful diversification means combining assets with different drivers and watching whether those relationships remain stable. It also helps to pair volatility measures with downside tools like drawdown analysis, stress testing, or scenario analysis. The goal is not a portfolio that never falls, but one that is built to avoid unnecessary damage. Section 3. Correlation. Correlation matters because a portfolio becomes fragile when many holdings respond to the same forces in the same direction. If several assets tend to drop together during a scare about rates, growth, or credit conditions, losses can stack up quickly. When holdings react differently, weakness in one area may be softened by stability or strength somewhere else. That is why diversification is about behavior, not just quantity. For holdings that all share the same economic exposure do not provide much protection. Correlation helps you see whether positions are likely to amplify one another or offset one another when conditions change. Correlation measures how two assets move in relation to each other, and it is expressed on a scale from -1 to +1. A value of +1 means the assets move perfectly together in the same direction. A value of 0 means there is no consistent linear relationship between their returns. A value of -1 means they move perfectly opposite each other. Most real-world asset pairs fall somewhere between those points, so the practical task is not to find perfection, but to understand how strong or weak the relationship tends to be. That single number can tell you a lot about diversification potential. The sign of correlation tells you direction, and the magnitude tells you strength. Positive correlation means returns tend to move together, though not necessarily by the same amount. Negative correlation means they often move in opposite directions, which can be especially helpful when trying to reduce volatility. A correlation near 0 suggests little consistent relationship, so one asset is less likely to echo the other. High positive correlation can quietly increase concentration risk, even if the holdings have different names. Lower or negative correlation, by contrast, can improve diversification because the portfolio is less dependent on a single shared outcome. Correlation reduces volatility because portfolio risk depends on interaction, not only on the riskiness of each holding by itself. Two assets can both be individually volatile, yet still combine into a smoother portfolio if they tend to zig and zag at different times. When one weakens while the other is stable or rising, the total portfolio movement becomes less extreme. With negative correlation, one asset may even offset part of the other's losses. This is a major reason diversification works. You do not necessarily have to give up expected return in order to reduce total volatility. Often you are simply improving how risks fit together. Consider a simple comparison between an all-growth stock portfolio and the portfolio that mixes growth stocks with long-term government bonds. The first portfolio is fully tied to equity market behavior, so its swings are likely to be larger. The mixed portfolio still has equity risk, but it also includes an asset influenced by different drivers such as interest rates and flight to safety demand. In some periods, bonds may hold steady or rise while stocks struggle, which can soften the overall decline. That does not eliminate losses, and it does not work perfectly in every environment. But when the relationship is not tightly positive, the combined portfolio may feel materially more manageable. A practical correlation analysis starts with matching return data for both assets over the same period and frequency. Daily, weekly, and monthly data can all be used, but they should be aligned so you are comparing, like with like. Then you calculate Pearson's R, which most spreadsheets and portfolio tools can do automatically. After that, interpret whether the result is closer to +1, 0, or -1, and think about what that means for diversification. If your goal is to reduce volatility, less correlated assets are generally more useful. The final step is ongoing review, because correlations drift over time and can change meaningfully across different market regimes. Correlation is a useful input, but it does not tell you whether an investment is good, cheap, liquid, or safe. An asset can have low correlation with the rest of your portfolio and still be a poor holding because of weak credit quality, poor valuation, or limited liquidity. In other words, diversification benefit does not automatically equal investment quality. You still need to ask whether the issuer is sound, whether the market for the asset could freeze under stress, and whether the price already reflects unrealistic optimism. A risky or overpriced asset does not become attractive just because it moves differently from everything else. Correlation helps with portfolio construction, but it cannot replace broader judgment. Imagine you already hold $50,000 in an S&P 500 index fund and want to invest another $50,000 with the goal of reducing volatility. One option is a technology ETF with a correlation of about +0.85 to the S&P 500. That choice adds more exposure to similar equity drivers, so the combined portfolio will likely swing in ways that resemble your existing holding. Another option is a Treasury bond ETF with a correlation of about -0.30. Because it tends to move differently, and sometimes in the opposite direction, it is more likely to smooth the overall path of returns. From a capital preservation perspective, the Treasury edition is the stronger diversifier in this example. Historical correlation is evidence, not a promise. Relationships between assets can strengthen, weaken, or even reverse as the economic environment changes. During calm periods, diversification may look reliable because asset behavior is more differentiated. During panics, fear can cause many holdings to fall together, a pattern often called correlation convergence or contagion. That means a portfolio that seemed balanced in normal conditions can become much more synchronized under stress. For that reason, correlation should be reviewed regularly and interpreted with humility. It is a useful guide, but never a guarantee. Several mistakes can make correlation analysis less useful than it appears. One is assuming that a relationship observed in the past will persist unchanged into the future. Another is using too little data, which can produce a noisy number that looks precise but is not reliable. It is also a mistake to treat low correlation as proof of safety, because two assets can be weakly related and still both carry substantial risk. Ignoring stress periods is especially dangerous, since that is often when diversification matters most, and with illiquid assets. Daily prices can be stale or distorted, so correlation estimates may need more caution than they first seem to require. The key takeaway is that correlation is one of the most practical tools for building a portfolio that does not move in lockstep. It helps you judge whether assets are likely to reinforce each other's moves or offset them. If your goal is to reduce volatility, lower or negative correlation is usually more helpful than piling up assets that all depend on the same outcome. At the same time, correlation must be used with judgment because market relationships shift, especially under stress. Regular review matters, and so does understanding what each asset actually does in the portfolio. Used well, correlation improves diversification. Used blindly, it can create false confidence. Section 4. Hedging. Hedging means adding a second position designed to offset some of the risk in a position you already own. The basic idea is similar to insurance. You accept a known cost today in exchange for protection against an uncertain loss later. A hedge usually does not remove all risk, and it is not meant to be a profit engine on its own. Its purpose is to make bad outcomes less damaging and more manageable. For example, if you own a stock and buy a put option, the put can gain value if the stock falls sharply. That gain helps absorb part of the loss on the original investment. There are several common tools for hedging, and the right one depends on what you own and what kind of risk you want to reduce. Put options are a classic choice when you want downside protection on a position you already hold. Short positions in related assets can also work, especially when the hedge is intended to offset broader market or sector exposure. Futures contracts are often used to hedge price exposure in indexes, commodities, interest rates, or currencies. Inverse ETFs provide another way to gain exposure that is designed to move opposite a market benchmark. Each tool can reduce risk, but each also comes with its own costs, limitations, and practical complications. A direct hedge is closely tied to the exact market exposure you want to protect, so it is usually more precise. If you own an index fund and buy protection directly linked to that same index, the hedge is closely matched. A cross hedge uses a related but not identical asset, which can still help but introduces mismatch risk. For example, hedging a specific company or niche asset with a broad sector instrument may reduce some market exposure while leaving company-specific risk behind. That means the hedge may work only partially, or it may work differently than expected during stress. In general, the closer the hedge matches the underlying exposure, the more reliable the protection tends to be. The central trade-off in hedging is simple. Better protection usually comes at a cost. Those costs can include option premiums, bid-ask spreads, commissions, financing expenses, or margin requirements. Capital may also be tied up in the hedge, which reduces flexibility elsewhere in the portfolio. Just as importantly, a hedge often reduces upside, because the same protection that softens losses can dampen gains when markets rise. That does not make hedging a bad idea, it just means it should be used intentionally. The real question is whether the reduction in downside risk is worth the drag on returns and the cash cost you have to pay. Hedging makes the most sense when you want to keep an investment, but have a specific reason to worry about downside risk. You may be committed to a position for long-term reasons, but concerned about a near-term event such as earnings, a policy announcement, or a macro shock. It can also be sensible when a potential loss would be especially difficult for you to tolerate, even if you still believe in the long-term case. In that setting, hedging can reduce volatility without forcing a full sale. It is generally less useful when the position is already short-term or when the hedge cost is so high that it overwhelms the benefit. Good hedging starts with a clear reason for wanting protection. A practical hedging process begins by identifying the exact risk you want to control. That might be broad equity downside, commodity price exposure, interest rate sensitivity, or something more specific. Then choose a hedge instrument that actually matches that risk as closely as possible. After that, decide whether you want full protection or only partial protection, because full hedges cost more and may reduce more upside. Before putting anything on, estimate the total cost, including premiums, spreads, and any carrying expenses. Most importantly, establish the hedge before the risk event unfolds, because protection often becomes more expensive once fear is already in the market. A hedge is not always something you place once and ignore. Markets move, exposures change, and the hedge itself can lose effectiveness over time, especially with options that approach expiration. That means you may need to review the position, adjust its size, or roll it into a later maturity if the original risk window remains open. It is also important to expect that the hedge may lose money when the main position rises, because that is often the normal cost of protection. When the specific risk passes, the hedge should usually be closed rather than left in place indefinitely. Keeping protection on too long can quietly become a drag on returns. A worked example shows how a cross hedge can reduce damage even when it is not perfect. Suppose you own 500 shares at $40, giving you a $20,000 position. You buy GLD, put options for a total cost of $200 as protection tied to a related market exposure. If the stock falls to $37, the stock position loses $1,500. If the hedge gains $1,200, your net result becomes a $500 loss after accounting for the hedge gain and its cost. The loss is not eliminated, but it is dramatically reduced, which is often exactly what a hedge is supposed to accomplish. Many hedging mistakes come from forgetting that the hedge is supposed to serve the original position, not become a separate bet. Overhedging is common, and it can create unnecessary cost or even reverse the portfolio's intended exposure. Cross hedges can also fail when the relationship between the asset and the hedge weakens at the wrong time. Another mistake is leaving protection in place long after the specific risk window has passed, which slowly drags on performance. Some investors also slide into speculation by increasing the hedge beyond what is needed for protection. A good hedge has a clear objective, a sensible size, and a defined time horizon. The main takeaway is to think of hedging as insurance, not as a shortcut to higher returns. Its value lies in limiting damage when uncertainty is unusually important, not in making every outcome better. A well-chosen hedge can reduce losses, lower volatility, and make it easier to stay disciplined during stressful periods. But that benefit comes with a price, and some upside may be sacrificed along the way. So the goal is not to hedge automatically all the time. The goal is to use protection intentionally, when the risk justifies the cost. Section 5. Black swans. A black swan is more than an ordinary bad market day. It refers to a rare, high-impact event that lies outside what most investors, institutions, and models were prepared to handle. Its rarity matters, but so does its severity. These events often appear obvious in hindsight, which is part of what makes them so deceptive. After the fact, people create stories that make the shock seem predictable. Historical examples often cited include the 1987 crash, the 2008 financial crisis, and the 2008 financial crisis and the 2008 pandemic shock. The important point is that black swans sit beyond normal expectations and can overwhelm systems built only for routine volatility. Routine volatility and black swans are not the same thing. Markets naturally experience daily fluctuations, pullbacks, and even periodic corrections, and those are part of normal risk. A black swan is different because it involves a deeper dislocation where standard assumptions stop working. Correlations can jump, liquidity can disappear, and price moves can become much larger or faster than normal models imply. So the defining issue is not just that the move is big. It is that the event is unusually disruptive and breaks the structure investors were relying on. Common risk models often miss black swans because they are built from the past and depend on stable assumptions. Historical data can tell you a lot about ordinary behavior, but it usually contains too few true extremes to represent tail risk well. Many models also assume that relationships such as volatility and correlation remain reasonably stable. In a crisis, those assumptions can fail all at once. Assets that look diversified may suddenly move together, and losses can arrive in forms the model treated as highly unlikely. The danger is not just inaccurate numbers, it is the false confidence those numbers can create. Planning for black swans starts with accepting two uncomfortable truths. First, you usually cannot predict the timing or trigger with enough reliability to act perfectly in advance. There is no indicator that warns before every crash, and waiting for certainty usually means waiting too long. Second, meaningful protection is rarely free. Cash buffers, hedges, and more conservative positioning often reduce returns during calm periods. That means preparation usually requires giving up some upside before the crisis arrives. The mindset shift is to stop trying to forecast precisely and start deciding what cost you are willing to pay for resilience. A practical response to black swans is to shift from prediction to preparedness. Instead of asking when the next shock will arrive, ask how your portfolio would behave if one arrived tomorrow. Stress test severe scenarios, even if they feel uncomfortable or unlikely. Measure the potential damage in dollar terms, because percentages can sound abstract while dollar losses feel real. Then identify which positions would cause the most pain and which assumptions are doing the most work in your portfolio. That approach does not eliminate uncertainty, but it makes fragility visible before the stress appears. Tail risk often hides in positions that look harmless during calm markets. Leveraged ETFs can magnify losses much faster than investors expect when markets move violently or trend poorly over time. Concentrated single stock positions create dependence on one name, one management team, and one set of company-specific outcomes. Illiquid assets become especially dangerous when everyone wants to exit at once and there are few buyers. Short volatility or calm-dependent strategies can produce many small gains while quietly storing up exposure to a rare but very large loss. These features often seem manageable in normal conditions, which is exactly why they deserve extra scrutiny. Asymmetric protection is attractive because it risks a limited amount in exchange for potentially large benefit during a crash. Put options are the classic example. If nothing severe happens, the most you typically lose is the premium you paid. But if markets fall hard, the value of the put can rise sharply and offset a meaningful portion of portfolio losses. Many investors use out-of-the-money index puts for this purpose because they are tied to broad market declines rather than a single stock. The trade-off is that these hedges often lose money slowly in calm periods, so they require patience and a clear reason for being held. There is also a dangerous form of asymmetry that works in the opposite direction. Some strategies earn many small gains for a long time by taking on hidden exposure to rare disasters. Selling deep out of the money puts or selling volatility for yield can look stable because most days nothing dramatic happens. But when the tail event arrives, the losses can be enormous and can wipe out years of steady gains. That is not black swan resilience. It is black swan vulnerability disguised as consistency. If upside is small and downside is catastrophic, the strategy may be collecting pennies in front of a very large steamroller. Liquidity is one of the most underrated forms of protection. Cash and highly liquid government bonds may seem unexciting when markets are rising, but they become extremely valuable when conditions deteriorate. They help you meet obligations without being forced to sell risk assets at depressed prices. They also create room to rebalance into opportunities when others are constrained. In a panic, flexibility itself is a defensive asset. A portfolio with some liquid reserves can often make better decisions under stress than a portfolio that is fully invested and trapped. Consider a $500,000 equity portfolio that buys two 6-month S&P 500 put contracts for a total premium of $8,000. If the market then drops 30%, the unhedged portfolio falls to $350,000, producing a loss of $150,000. With the hedge in place, the puts gain $120,000. After subtracting the original premium, The net loss becomes $38,000 instead of $150,000. That is a dramatic difference in damage, even though the hedge did not remove losses completely. It also creates liquidity at the moment when attractive assets may be available at depressed prices. Black swan protection often feels wasteful right before it becomes essential, which is why discipline matters so much. One mistake is judging protection only during quiet markets, when the hedge appears to be a drag and the danger seems remote. Another is assuming diversification will always hold, even though correlations often rise during crises. Very short-dated hedges create a timing problem because they can expire before the real shock arrives. It is also a mistake to treat stop-loss orders as a true hedge, since gap risk can cause execution far below the intended level. Good protection habits require patience during the very periods when protection feels least necessary. The core discipline is to build portfolios for resilience rather than for perfect prediction. Black swans cannot be forecast with precision, but fragility can still be reduced. That means limiting exposures that can break under stress, preserving liquidity, and accepting the cost of protection before the crisis arrives. It also means aiming first to survive extraordinary conditions without permanent damage or forced selling. Investors who remain intact after a shock still have choices, capital, and time. In the end, Black Swan preparation is not about calling the next disaster correctly. It is about making sure one disaster does not end the game.